Hi, fools. Welcome to Real Talk on Backstage. I am Matt Frankel, your host. I am joined by Scott Sanis. He is CFO of Janus International. They recently went public via SPAC, and he is here to tell us about his business, what they do, and kind of answer a few questions about what's going on in the self-storage real estate world. So, Scott, thank you so much for joining me today.
Thanks for having me, Matt.
Awesome. So, you are a CFO of a company called Janus International. For those of us who might be unfamiliar, I'm familiar with what you do, but for those who aren't, can you give us a quick overview of what you do?
Sure, happy to do that, Matt. Janus is a leading global manufacturer and supplier of turnkey self-storage, commercial and industrial building solutions, including roll-up and swing doors, hallway systems, relocatable storage units, and facility and door automation technologies. We are the provider of choice for new construction and what we refer to as R3, which stands for replacement, remix, and renovation, which represents our aftermarket business. We are integrated throughout every phase of a project by providing solutions spanning from facility planning and design, construction, technology, and the replacement, remix, and renovation of damaged or end-of-life products.
So at least around me, the self-storage industry has really been doing very well lately. I imagine you're seeing that pretty much all over. So this sounds like a really interesting business. One of the reasons I personally like the self-storage business is because the economics are great. It's not a very capital heavy form of real estate as compared to, say, building a hospital or an office building or anything like that. So can you briefly just kind of walk us through the economics of the business? You're the leader in what you do. So why is this an attractive business from a financial perspective?
Sure, great question. So overall, the health of the industry and our business has kind of remained robust throughout the past year plus. We point to occupancy rates in the mid-90s, which is well above the historical norm of the mid-80s for the industry. And why that's important is that, in order to return to kind of the mid-80s level, a significant amount of new additional capacity needs to be brought online. And in addition to that, the installed base of the self-storage properties consists of approximately 60% of facilities being greater than 20 years old. And customers of self-storage facilities continue to demand more modern, safe, accessible facilities. So the owners are increasingly turning to us to provide that through the program. And as we watch the investments REITs and other institutional investors are making in the sector, we expect that trend to continue and potentially accelerate, which bodes well for our business.
You just mentioned the REITs. I imagine that there are only a handful of publicly traded self-storage REITs. So I'd imagine that most of them are your customers in one form or another.
That is correct.
All right. So you briefly answered this next question already, but I kind of want to dig into it a little bit more. You mentioned the need to modernize the self-storage industry. I know there are probably a dozen self-storage facilities within 3 miles of my house. Most of them look like garages that were built in the 1970s. Some of them look like big modern buildings. Can you kind of walk us through, when you say modernizing the self-storage space, we don't just mean newer garages. We mean, incorporating technology into them, making them kind of what modern customers want. So can you walk us through a little bit of what that means, why it's important, and why it makes it a better business?
Sure. Yeah, I can maybe address your, kind of the first part of the question and then kind of, peel back the onion a little bit. So you mentioned, really when self-storage kind of started in the United States, it was more of, I'll call it the traditional drive-up locations, right? So sprawling space with, kind of generally speaking, single-story drive-up facilities. Today, you see kind of multi-level, climate-controlled, obviously just with the scarcity of land, you've seen that model change significantly. And with the new model, you're able to obviously modernize the facility, if you will, and use things such as the Noki Smart Entry product line, which will I'll touch on here in a second. But basically, a couple of things are really driving that modernization. So, one of them is, as I alluded to earlier, the REITs and the institutional investors. That segment of the industry tends to be kind of very ROI focused, and they're going to continue to, reinvest in their facilities and modernize them as they are competing for, customers. And in addition, as the REITs and the institutional investors continue to consolidate the marketplace, that will create tailwinds for our business in terms of the R3 opportunity, or again, the aftermarket business. Again, we kind of, touched on the aging of the self-storage facilities, the useful life of a storage unit, kind of without refurbishment tends to be somewhere between 25 to 30 years. And if you imagine, as I kind of, gave you a little bit of a picture, a typical unit built, 25, 30 years ago looks very different from, what is being built today. Most of the owners, generally speaking, do not do major updates or overhauls until their facilities are, circa 20 years or older, or, sooner if they get, kind of consolidated up by the institutional investors. And then, I think lastly, I'll just kind of touch on our Noki Smart Entry product offering, which I alluded to from a modernization. That's our kind of access control solution, which enables tenants to access their self-storage units via mobile app. And that, had the interest in that product line has been bolstered by the pandemic, in that we're seeing more and more demand for contactless business transactions.
So I would imagine something like the Noki system would add value from an ROI standpoint as well. I know, for example, in the apartment industry, that if you add smart home technology to a building, it makes it more valuable rent-wise. I would imagine the same thing could be said for the Noki system, to the point where it would pay for itself almost.
Yeah, great point. So we're seeing, again, with the ROI-driven section of the self-storage industry, which tends to be the REITs and the institutional investors, that they are getting kind of that ROI computation, if you will. And you're absolutely right. There's a ton of, it kind of changes by, facility and by dynamics, but, we're seeing, the owner operator able to charge incremental rental rates for having kind of the smart unit. We're also seeing commercial insurance savings because there's security features with the Noki Smart Entry product line as well. And then in addition to that, you're also seeing some of the individuals kind of employ dynamic pricing models, in that they have the ability now to, access to data, telling them how many times individuals are, accessing, self-storage facilities. And maybe just, quick case in point, it's estimated that about 20% of self-storage kind of tenants are commercial tenants, which tend to create a significant amount of wear and tear on a facility. And now with the access to the data, i.e. how many times somebody is accessing the unit on a daily basis through the mobile app, they're able to, utilize that. And again, with the high occupancy rates that, exist today, and the ability to continue to drive up pricing, we're seeing some owner operators, raise rates for those commercial tenants. And, if they're able to get the incremental revenue, great. If they vacate, they'll still be able to probably drive up, the rental rate and get less wear and tear on their facility. So there's a lot of levers that, an owner operator can pull. And to your point, we are seeing, sometime the payback being, less than a year, depending on the facility.
Excellent. So you mentioned a little while ago that I think you said industry-wide occupancies are in the 90s right now. Historically, they were in the mid-80s. So it seems like that would be a perfect environment for organic growth in your business. But I was looking at some of your materials, and you've been very acquisition heavy in the past. I want to say 11 acquisitions since 2013. So how do you see, what's your growth strategy in the near term as that kind of, the market starts to find equilibrium, and kind of on a more long-term perspective?
Yeah, great question, Matt. So, several levers there for us to kind of grow. You touched on, over the past kind of 2 decades, we've consistently expanded our product offerings, to the self-storage industry, while also diversifying product and solution offerings into the commercial, industrial, and markets. Over just the past 5 years, we've doubled our business. We expect to replicate that growth rate in the future. We have a very strong position in self-storage and a leading position with our customers in all of our business segments. We feel that our market position, along with our innovation and integrated approach, have put us on a path to continue to take market share. An important part of our story is innovation, as we've just kind of touched on. We're taking, several steps to combine our best-in-class self-storage offerings with new and innovative technologies to redefine the total self-storage experience. One of the largest innovations and biggest growth opportunities is that of our Nokē Smart Entry product line that we've, just touched on. And for us, that's a multi-billion-dollar opportunity. So we're, very excited about the potential opportunity that product brings to the business. You mentioned M&A activity as well. In August, we announced the strategic acquisition of DBCI, a manufacturer of steel roll-up doors and building products for both the commercial and self-storage industries from Cornerstone Building Brands. The acquisition broadens our customer set to now include DBCI's core general contractor and distributor base, and it provides us an opportunity to deliver more comprehensive value-added solutions to them. And we're very excited about what the future growth potential of the DBCI business presents for Janus. A couple of other, key levers for us. We're continually focused on growing our content per square foot within the self-storage industry. We have a track record of consistent growth here, and we're focused on continuing to grow our wallet share with our existing customer base. I think another key growth platform for the business is the commercial market opportunity. We believe that it presents significant, opportunity for growth, especially when you consider our current estimated market share is approximately 5%. And we're continuing to focus on our strategic growth plans there to grab market share. We expect to continue to leverage our excellent customer service to further penetrate the large addressable markets, largely, R3 and, the aforementioned Nokē access control. We already touched upon, the industry and market fundamentals with the high occupancy rates and the aging install base, which also, continue to create tailwinds for the business. And I think maybe lastly, we intend, as you mentioned and alluded to, the significant kind of track record of M&A activity. We continue to intend to build upon our strong track record of identifying, executing, and integrating acquisitions to support our strategic growth. Focusing on diversifying into attractive adjacencies. Continue to expand our geographic footprint, and continue to support our technology innovation to better service our customers.
So you mentioned you're one of the leaders, or I know you're one of the leaders in your space, but you said you have a 5% market share a minute ago. That leads me to believe that this is a very fragmented industry. Where does everyone get their self-storage properties if it's not from you guys?
Yeah, apologies for the confusion there. The 5% is on the commercial sales channel of our business. Our market share in the self-storage industry would be over 50%.
Okay, I thought so. I thought we had a whole new growth lever to go after.
No.
So I know you've kind of started to branch out from self-storage into other types of commercial buildings. How big of an opportunity do you see this? I know self-storage is really your bread and butter. I mean, do you see it staying that way, or do you see it really branching out a lot more?
Yeah, great question. I think, a couple things there. Again, as we've touched on, right, with high occupancy rates, well into the mid 90s, there's a significant need for new capacity. And, that can come from both greenfield development like we've historically seen, or increasingly today from kind of a combination of refurbishments and repurposing of existing facilities Internally, we kind of refer to those as both conversions and expansions. And, the growth of e-commerce, somewhat accelerated by the pandemic, has had upward pressure on warehousing needs, which has resulted in a lot of big box retail space becoming available. Those facilities, in many cases are ideal for repurposing or converting into self-storage capacity. And we're there to, help those, owner operators, developers with, that side of the offering. The sales process is similar to what we have, done for years, partnering with the owner of the facility and creating the solution that they need. And again, it's not a secret that the REITs, as well as the institutional investors have been particularly active in the self-storage industry. And again, that creates additional tailwinds for us on further, R3 opportunities. And in addition to the conversion and expansion opportunity within the self-storage marketplace that, these big box retailers, coming online provide, it also creates tailwinds for our commercial business in that, as they shift that, kind of, brick and mortar from, retail space to more warehousing and distribution. Again, that is creating tailwinds for our commercial business. And as we've previously just kind of clarified, today we have a circa 5% market share. So that's, there's a tremendous amount of runway for future growth on the commercial side of the business as well.
Okay, so we've so far focused on the good. Now let's talk about something not so good. If you've tried to buy anything recently, there's supply chain issues virtually everywhere. I had a contractor recently tell me that the steel industry is backed up by 4 months right now. If I wanted something for my house. So how much is that affecting your business? And how much of a short-term headwind do you see that?
Yeah, great question. It's obviously affecting, everyone today. Supply chain issues are obviously a significant concern, for the business. Our teams are working together, efficiently and effectively to kind of execute, as again, effectively as possible in these unprecedented times. The company has taken actions to offset the inflationary effects through both commercial and cost containment initiatives. We do expect to see kind of continued benefits of these actions, build in the second half of 21 and into, the first half of 22. I would say one thing that, has benefited the business is, a few years ago, we really kind of put a primary focus on identifying, any of our kind of sole sourced components. And we worked hard at identifying and qualifying kind of secondary and tertiary suppliers. That exercise has proven invaluable, again, based on these, unprecedented times with, not only the raw material inflation, but also the capacity constraints that you've alluded to. And it just gives us a few more levers to potentially pull because we're not, kind of handcuffed to one supplier, but, in many cases, we've got, alternative qualified sources.
So Janus has been around for a while, correct? How long has your company been established for?
Yeah, we were established in 2002.
Okay. And you said you have over 50% share of your core market. So Janus recently went public. You went public this year through a SPAC, which shouldn't come as a big surprise. It's 2021 after all. But you kind of strike me as a relatively mature company to choose the SPAC route. A lot of kind of early stage companies are going public through SPAC right now. Not too many market leading mature businesses, if you will. Not that you're mature in the sense that you don't have a lot of room to grow, but you're a leader. So why did Janus choose the SPAC route to go public? I'm sure there's a reason, but it just doesn't seem like you're the typical SPAC IPO.
No, it's a great question, Matt. So there's a couple of items I can kind of, address there. So going public has been part of the long-term vision for Janus, and our business model is always focused on growth. We've maintained an organic compounded, annual growth rate of, circa 10% since 2016. And with M&A activity, we've nearly doubled our business since that time. But, maybe to directly kind of answer your question, we elected to go public via SPAC because in Juniper, we found the optimal partner to help grow our business. The company was highly familiar with the building product industry through its management's long and distinguished careers at Honeywell. Similarly, Juniper had evaluated several companies and determined that Janus's potential as a market-leading technology and solutions provider to the self-storage, commercial, and industrial markets with strong financials, compelling growth trends, and a loyal and diversified customer and employee base provided a great investment opportunity that paired well with its founder strengths. Also as a public company, we plan to continue investing in technology innovation, expanding our geographic footprint. For example, our highly accretive M&A program has enabled Janus to become a first mover in self-storage smart access control technology via our acquisition of Noki. It's allowed us to expand into adjacencies like exterior building solutions, commercial roll-up steel doors, and you continue to grow our international footprint.
So another thing that usually comes with a SPAC IPO, just to kind of follow up on that, is capital. SPACs usually provide a nice capital infusion. I'm not sure the exact figure. I want to say it was in the $350 million ballpark that came in from your SPAC deal. So how do you plan on kind of leveraging that capital to achieve all those growth levers you were saying? Like, what's the growth priority right now with that? Yeah,
it's a great question. I think the way that I would kind of describe that is, we're going to maintain a balanced approach to kind of capital allocation. The proceeds that you mentioned, it went to basically delevering the business at the time of taking the company public, and then kind of a modest payout to the existing shareholders as well. But again, we're going to be prudent. We consider ourselves to be a high growth business. So our primary focus is going to continue to be to have GDP plus growth rates on an annual basis. And in order to do that, we're going to be aggressive with capital deployment via CapEx, strategic growth initiatives, as well as M&A activity. Our business also generates a significant amount of kind of free cash flow, and so we're confident, despite all of those investments, that we'll still be able to kind of consistently delever the business over time as well.
Excellent. So just a few more. What about the self-storage industry in general? I know we've talked a little bit about how right now occupancies are in the 90s. It's historically in the mid 80s. It seems like an industry that has a lot of ups and downs in terms of supply and demand. I know a few years ago, there was a lot of oversupply issues in a lot of key markets, like it had just been built out a little too fast. So what are your general thoughts on the current state of the self-storage industry? I know you mentioned that, right now supply is a little behind demand in terms of there's still a little too much demand and the market could support more inventory. How long do you think it'll take to kind of equilibrate, I guess would be the way to say it? And just what are your thoughts in terms of general supply and demand? Do you see it like as a big cycle or do you see it kind of stabilizing for a while?
Yeah, great question. I mean, if you are correct. If you go back kind of, through time, I think what kind of happened right before the, kind of the 08-09 recession was you had a significant amount of capacity being brought online, but at the same time, you had occupancy rates actually kind of declining. And so, the market got to a point of a little bit of overcapacity, and then you had the recession hit. And then I would say that you had self-storage, owner operators, especially the REITs, kind of go on public record saying that probably the biggest mistake they made in their, career, at least during those recessionary times, was not to continue to invest in, new capacity, because they could have done it for a lot, less than what they were doing it for, several years later. But, if you look at all the fundamentals today, low cost of capital, you got high occupancy rates, you got rents at or near all-time highs, the fundamentals of the self-storage industry are all tremendous, and we believe that, right now there's really no, that those fundamentals are looking strong into the foreseeable future. So we feel like there's a pretty good runway here for growth over the next several years for the business.
Excellent. And so what do you see as the biggest challenges to your business going forward? Is it maintaining the growth? Because you mentioned you've been a growth company since the beginning. Do you see growth as being your biggest challenge? Do you see kind of expanding into new verticals going forward as a big challenge? Where do you, I don't want to say most concerned with, but what do you see as the biggest challenges and biggest opportunities right now?
Yeah. So challenges, I would say, for me, that's kind of an easy one. It's what we talked about earlier. You've got just unprecedented times in terms of both inflation and capacity, and supply constraints in terms of raw material. We touched on the raw material. What we didn't touch on is labor and logistics. And we're seeing kind of similar things there with, unprecedented, inflation, as well as, especially on the labor front, just the capacity or the limited capacity or availability of labor in the current marketplace. So, all three of those, continue to present some headwinds to the business. We're focused on those each and every day. Happy with the team's performance, to date, again, in each one of those segments, but it is something that we're watching, closely and continuing to monitor. So I think on a challenge, that would be, my comment. As far as opportunities, I think we touched on a lot of them, when I kind of addressed the growth. We're super excited about the Noki, smart entry, platform and what that, from a access control technology, what that affords the business in terms of growth potential. The commercial, opportunity is tremendous for the business with, only circa 5% market share. You've got, the DBCI acquisition. We're very bullish on what that brings to the business and, the growth opportunities that presents, and just some of the other, recent or even, past kind of M&A activity in terms of our, Betco business unit and the building components, and growing that business geographically, the ASTA business unit we bought several years ago and the commercialization of the rolling steel product line, again, to go, take market share, in an extremely large, total addressable market, again, which we have a very low, market share today. So from our perspective, there's just a ton of levers. We're very excited about what the future holds, and we just need to go out and execute and continue to grow the business as we have in the past.
Excellent. So last thing, we've talked about the self-storage REITs often on this show. One thing I think investors kind of need to know about your business is you don't care which of the REITs win. You partner with a lot of them. They're your customer. So you are more at play on the industry instead of kind of competing against a bunch of other players in the space, which is kind of an interesting dynamic from my perspective, anyway. But I'll give you the last word. Is there anything you would want people to know about your company? Because I feel like a lot of viewers are not familiar with what you do. So I'll give you the last word on it.
No, yeah, appreciate that, Matt. I think what I would probably just like to leave everybody with is, kind of, from the discussion today, again, excuse me, Janus obviously does supply the marketplace with products and services. But I think, we don't really view ourselves as as a manufacturing company, despite the fact that we manufacture products. We consider ourselves to be a solution provider, right? And thus that is why we command the margin profile that we command. We have the cash flow profile that we, command, I'm sorry, because again, customers come to us and know that we will be able to come up with a solution for them, whether, they're new to the industry, whether they're a veteran to the industry. We have very long-standing relationships with customers that they know that we will execute, we will get the job done, we'll get the job done on time, and, they can rely on us and the expertise that we bring to help them, maximize their return on their investment.
Excellent. Well, Scott, thank you so much for joining us today, and we hope to talk to you again very soon.
Sounds great. Thanks for having us. Thanks for having me, Matt.